Hi, Andrew Myrons from Intuitive Finance here. Well, what's the most common question I'm getting asked at the moment? Well, not surprising, it's all around interest rates. And how or what, Andrew, can I do to reduce my interest rates? So the first thing we have to determine is what type of loan is it? Is it a home loan or is it an investment loan? And then the second part of that is it principal and interest or interest only? They're now the tiers that are starting to segregate what type of rate you can get, what price you pay, and whether or what the best outcome is. So let's talk about a couple of options. Firstly, if you've got a home loan, my fundamental belief is you should be repaying that principal interest. There's no tax benefits. There's no reason not to be paying principal interest on your home loan. It's a good commitment. It's a good discipline. And right now, today, everyone should be still able to get a home loan interest rate less than 4%. And that's with all the bells and whistles, offset accounts, redraw, extra payments, and all the things that we like to attach with that. Okay, so that's the first thing with your home loan. Rates should be less than 4% in the current market. Then, with your investment loans, okay, as a rule, Australians are generally complacent. So we've had for the last 2 or 3 years rates coming down, coming down, coming down. And then we had a price war where banks were actively competing for business around about a year ago now. So sort of from June 16 to December 16, there was a real price war to try and fatten up and grow loan volumes. At the same time, then we had regulators saying to our lenders they had to reduce their year-on-year growth of investor volumes by 10% to a 10% average growth rate. And then in 2017, we've seen them reduce the amount of interest-only lending from, in some lenders' cases, 40 and 50% of all new applications to now down to world standards of 30%, all new applications being at interest only. So what has that done? Well, the banks have pulled a number of triggers. The first one being that the greatest disincentive to most people is interest rate. It will stop people from doing things. It's kind of a little bit laughable. Would you pay 1% more today to experience growth like we have in Melbourne and Sydney over the last few years of 12 to 15%? It's kind of a no-brainer, isn't it? But still, when we look at that bottom line, the greatest disincentive is rate. So what can we do about our rates? Well, the price war is over, but there's still some things we can do. The first thing is let's review your investment loans. Let's have a look at them. Let's have a look at the ideology, what you want to achieve, and your goals there. For some people, paying principal and interest on your investment loan might be the right thing. And if that is the case, we can still achieve rates in the very low fours for a principal and interest investment loan. When you start talking interest only though, now you're starting to look into the mid to high fours and even for a lot of lenders now in the 5% range. Well over 1% dearer than a principal and interest home loan. That's just how the market has dislocated in terms of now allocating price to risk and risk being what can do and how people need to assess and be able to repay their debt. So if it is still interest only that you want to retain, or you're willing to consider principal and interest, another great option you can look at is looking to fix your interest rate. A lot of our fixed rates are now at or below the same as the variable rate. So if you can fix for the next 2, 3, 5 years at a rate that's similar or less than you can get today, I think that won't be a bad strategy. Rates are at all-time lows. They're not going to stay down here forever. The other thing that everyone should do is it costs you nothing, maybe a phone call, to ask your lender or your broker, am I on the best deal? Often lenders, it's cheaper for them to retain your business at a slightly lower interest rate than the risk of losing it altogether. So lenders will often look at what's your loan volumes, what's the loan balances, what's the characteristics like, and if you're a good client, they will often offer you a little sweetener in terms of a better deal just to retain your business. All right, so that's really clear. At the end of the day, I think what you have to be is really clear in your goals. Everyone has to know what you want to achieve And if you are, then you can manufacture and manipulate your rates around that. If you're just investing with no end goal or end game plan, I think you've got the potential to become a cropper. The regulators aren't going to let up until we see some of our markets moderate, most particularly Melbourne and Sydney. I suspect that there'll be some continuing focus on living expenses in the future, so potentially investing is going to even get a little bit more complex and maybe more difficult for the back of 17 and for 2018. So consider all those strategies, and of course we're always here. We'd love to speak to you and do a review on your options if you like. But until next time, we'll see you soon.